Hey guys, Doug the Retirement Guy. We got a review of the YieldMax MSFO Option Income Strategy ETF. This is the option strategy using the Microsoft stock. Kind of question is this good for a retirement account? Their dividend yield showing out there at 20.37. This is one of those things that got us interested, and so let's check into it and see if it's worthwhile being in our portfolio. But before we get into that, guys, I want to thank each and every one of you for watching our videos. The subscriber count is climbing and doing a great job, and we appreciate it. We give you guys a thumbs up for that. We also added a Patreon. If you guys want to support the channel more than just being a subscriber, click down in the description. You'll see our Patreon link. Click on that. Help the channel any which way you can. If it's buy us a Coke, keeps us motivated, keeps us under caffeine, we appreciate it. We appreciate everything that you guys do. Let's get into the video today. MSFO, the YieldMax Microsoft Option Income Strategy. Basically, guys, it works like a lot of the funds that we've seen from YieldMax is they take Microsoft shares of stock, they sell covered call options to it to generate income. It's a neat strategy. It's a strategy that seems to, a lot of different companies are doing this. Seems to work. But it's the big asterisk I put out there is that you're dealing with one stock only. If Microsoft goes up, great. If it goes down, great. But that's all you have. You have no flexibility with anything else to cover a good day or a bad day. Distribution rate 22.21% and a 30-day SEC yield of 3.53. All right, when we take a look at the holdings of this account, it's no different than what we see in most YieldMax's versions. And they hold the U.S. Treasury notes and bonds. They do it in multiple what they call packs, which is the expiration dates or certain periods in time and so on. But they're putting 120, if you look at these numbers, $120 million into something, and they're getting a 2.6, 3%, 3.8%. So they're getting some big returns to give you some nice interest returns. And then also, of course, you got some Microsoft stock that they're taking and selling that in their covered calls. So why MSFO? Well, it starts with is the advertising at 22.21% return and at 3.5 30-day yield. The 22% return is over a specific period, which includes your dividends and your interest in like capital gains. That's why those $120 million tied into a 2 and a 3% interest rates, they continuously add up. A 3.53 dividend, or excuse me, a 3.53 30-day SEC yield shows that's some potential income, and that's being covered because of those treasury bonds and notes. Now, the nice thing is they do make this so it's a monthly dividend payout. And here on the channel, we love the dividends and we love our monthly payouts as a minimum. It's because you can reinvest your dividends into doing what we call a drip, which is buy more stock with the dividend and just keep adding in a couple shares every month into this and then growing your, basically taking a double dip of your investment and getting more and more shares for it. Now on the channel here, we like that regular cash flow because we are worried about retirement. We want a check to come in to pay our bills each and every month, and that's what we look for. Now this fund has been out since August of 2023, so it's got that year, almost a year and a half time period into it. So that gives us enough information that we can make some good decisions about, is this a fund that we want to be invested in? We take a look at the returns, and they won't say they're good, but I won't say they're bad at the same time. But 1 month out, the Microsoft is down 3%. 3 months out, they're down 6%. 6 months out, they're down 4.73%. Year to date, they're down 4.78. 1 year, they're down 2.2. But since inception is 25% gain. So it looks like we're really into a major in the past 12 months. We've had some major drop-offs in the Microsoft portfolio. So what we do is we take our $10,000, we roll it into the stock, we buy stock. If this time we would buy it at $22.39 a year ago, which is March 5th. With $10,000 originally invested, we would have been able to buy 446 shares. And if we take a fast speed all the way to March 5th of 2025, our value has lost 25%. So basically our stock went from $22 all the way down to $16, losing 25.15%. Now on the dividend side of it, we would have picked up $2,517 or 25.17%, which is some great big numbers, But when you lose your NAV as you do, you really only made $2.95 for a total of less than 0.03%. So again, this is a great program to look at when people say, hey, I'm making 25% dividend on this fund. What's it costing you to make the 25? It was something I was always laughed at when we go to a casino. Someone would tell me I won $1,000, and I always ask, what would it cost you to win that 1,000? And this is a prime example of that. It costs you just as much to get that 25% dividend. Again, we look at the stock of this thing as a flat, no pikes, there's no peaks, there's no drop offs. It started at a certain level and it just pretty much dropped off. As that stock does not have any growth, it does not have anything to pump up to give it something to lose, it's hard to deal with. So you look at the highest price point at $22.39. Your average came in at 19.92, and currently that stock is now 16.76%, and that's a 15% below average. Now, we've talked other times about stocks. 15% discount right now, maybe a good time to buy into it? And the answer is no, because your stock lost 25% of its value. So if you're not buying below the 25% discount line, you're not getting a deal. So this stock still, to me, in my eyes, is still about 10% too high, about a $2 too high right now. Even though the Morningstar gives a conservative number 3 rating, to me, it's just not performing anywhere close to what we want it to be. So in summary, when you got a stock that's losing 25%, that's a thumbs down. You got a dividend of 25.17% gain. Now, of course, we got to give that thing a thumbs up. But bottom line is when you're giving all your dividends back to get your total return, this is not a stock I even want to be invested in. I don't want to even look at it. It's just not worthwhile being there until someone proves to me that that stock market can take off. So again, we give this 2 thumbs down. So is this good for a retirement account? I think you guys are probably all well educated, and that's a definite no. You got a great dividend at 25, but your NAV loss is negative 25. So it pretty much puts you at a zero gain, a zero growth, zero anything. So you basically have to put too much of your dividend in to recover the cost. There is no way at all that you can make this thing up. So my guys, I put this as a complete hold.